Hi, everyone, and welcome to this session on Budget 2022 for individual taxpayers. Let's try and understand what all happened on 1st February. We all had a lot of expectation that there will be at least some tinkering that would have been, thought about for individual taxpayers. Any changes, for tax relief, but unfortunately, none of those were brought in. But we'll walk through the budget. We'll try and understand how you all are impacted, and if you all have any crypto investments, I think then the budget had a lot of news for you, and we'll go over that in much greater detail.
Hi Preeti and hi everyone. Regarding this budget, as we all know, some of the direct taxes changes were also in this budget. So I have some questions for you to ask some general questions. So first, I would like to know that what is the easiest way to update a filed and processed return?
Right. So, this has become a great topic of discussion. And in the last few budgets, the government had actually shortened the period that was allowed to you for revising your return. And that was actually a lenient approach where they said, if you have made any error while filing your return and it has not yet been processed, then you can actually, go ahead and revise it. And that did not come with any penalties. So it meant that if you had any additional tax dues, or even if you had a refund, you could revise your return, you could make changes. But that effectively, the time period allowed for that was reduced way back. It was made really short. You had to close all of this within the assessment year, uh, before the
Mhm.
assessment year ended, and that was only possible if your return had not been processed by the department. What has happened now is more like, you can call it an amnesty scheme, or you can call it an opportunity for taxpayers to come forward and voluntarily make a disclosure, if they have failed to report something. And mind you, this updation or revision of return is only possible when you have additional tax payable. So if you have a refund situation that is going to arise, or if you have a situation where your refunds are going to increase, in these scenarios you will not be allowed to update your return. You will only be able to update your return if you have additional tax payable.
Actually,
So not only this, when you take shelter of this provision and you go ahead and update it, it there should be no search or seizure by the income tax department that has been initiated against you. That's another very, very important and relevant point. If the department has initiated certain proceedings against you, then you cannot go ahead and update your return. The third and very important aspect is that the penalties are huge. So if you end up with additional tax payable when you're updating your return, you will have to pay 25% additional tax on your total income tax plus interest. So additional 25% if you update your return within 12 months from the end of the assessment year. But if you go beyond that period, so if you go from, say the 13th month to the 24th month, then you have to pay 50% additional tax on, tax plus interest. And I was trying to do some rough calculations and figured that you might end up paying in some scenarios 110% tax on your income, which means you pay more tax
really.
than what you have earned. And so this is actually a very, very punitive kind of section that has come. Let's not understand it as an opportunity to revise, to sort of revise your mistakes, remove your mistakes for your benefit, but rather as very, very punitive, and sort of like discouraging you to make sure that the first time that you file your return, it is fully accurate, and you've considered all your incomes and you've reported everything accurately. I think that now needs to be done in the first go very properly.
Right, right. Okay, that was great explanation about this. So yeah, we'll make sure that we are filing our return on time only to avoid all this extra penalty things. Even the government has proposed a new this amendment. So talking about my next question. So as we all know that many of us are investing in this cryptocurrency thing, and government has put a 30% tax slab on this. So the new rule on this crypto taxation calls for 30% tax rate. So do you think that it is going to discourage people from trading in crypto despite it being legalized?
Right. So, let's try and understand that when we say that the government has, decided to levy tax on it, essentially it does not mean that it has become legal. So, that's the first premise. Also, a couple of days back, we had the revenue secretary mention that the legality of this kind of a virtual digital asset will be decided by relevant authorities, and I think he was hinting towards the RBI. So, the legal aspect of this is going to be decided by the RBI, probably by the courts, and it may be subject to a lot of litigation. And that's not the area that we are going to get into right now, because we don't have anything from the government on whether this is legal or illegal in that sense. All that we have right now, that if you have crypto income, it is going to get taxed. Now let's try and
Okay.
understand in detail, what are the provisions that relate to crypto taxation. So they've actually
Mhm.
introduced four sections, and all of us may not be tax experts, but be conversant with the Income Tax Act. So I'll try to break down what has truly happened. Firstly, they've decided to define what exactly is a virtual digital asset. So there is no mention of cryptocurrencies, but they've clubbed all of these into what they call a virtual digital asset. And a virtual digital asset, they've clarified that it is not any Indian currency or any foreign currency, but it is a currency which is digitized, which has been generated through cryptographic means, which.
They just mentioned the digital asset word, na? Not the foreign asset or Indian asset, like whatever currency it will be. It is just a digital asset.
Correct. And so, in that sense, but they also said that non fungible tokens, so NFTs, they said will fall under the definition of virtual digital assets. And I think that is pretty progressive, that they've taken cognizance of the fact that there are investors who may be investing in NFTs, but they've said that they're going to notify which NFTs will get captured under this particular definition. Also, they've given, this section gives powers to the central government, that out of their own choice, they can choose to notify certain currencies as virtual digital assets, or denotify them. So they can give out a notification saying that these are the currencies that we consider to be VDAs, and these are the currencies that we consider not to be VDAs. So both ways, they will be able to notify. And also, there's a lot of discussion around what truly constitutes a virtual digital asset, and the definition provided is so vast, that there are certain kinds of digital wallets and digital currencies, reward coins and all that, which may likely fall under this kind of a wide scoped definition. And it appears that what they're trying to do is build a definition which is very progressive, in the sense, they want to be futuristic, that if in the future there are these reward coins, or there are these certain unique kind of digital transactions which they are not able to tax, they may also start to fall under virtual digital assets. So that's on the definition. Now coming to taxation, what they have said, that if there is if you have any income from transfer of VDAs, then you have to pay tax, and the rate of tax is a flat 30%, which means that you will, if you say fall under the 15% or the 20% slab, ignore that, just flat 30%. And mind you, there is a 4% cess, so that also becomes applicable. And that is how they have said that crypto income will be taxed. Another interesting aspect is that if you look at strictly how the law has been worded, what they mean is that in the same financial year, say for example, you bought two coins and you sold one coin at a profit, the other coin at a loss, you will not be allowed to set off your loss from the gain. So for the same cryptocurrency or for a different cryptocurrency, you will not have the liberty to set off your losses. So in that sense, all your gross profits will be taxable, and losses you just need to ignore. So it's
So
not.
even if it is a cryptocurrency loss, then too it will not get set off with cryptocurrency gains. You are
That's right.
saying this?
That's right. So
Right.
this is
Okay.
how
Okay.
they have worded the law. So if you look at strictly how the law has been worded, this is the inference that we can draw, uh, and maybe they issue a clarification or to go ahead and amend it. But as of today, this is how it stands, and they would like to clarify it in future, and there may be more details available. this is how it stands right now, and it's kind of very very conservatively drafted. If you look at assets like equity or there are several set offs available, so you can set off losses even in a business from capital gains, house property loss. So there are various kinds of set offs which are
Setups
based on in
available.
the act. But in case of crypto gains, no loss set off is allowed. Also, if you have loss in 1 year, you're not allowed to carry it forward to the next year to set off. So there is no set off, no carry forward. Basically, all your losses are dead losses. That is what they have said. Then
So,
there are
Preeti, don't you think that it will discourage the layman to invest in crypto or any kind of digital asset if there is no set off, no carry forward thing? So, why would a layman will invest? Like, they'll obviously think that it's not sure, it's a risky thing. So, it's
right.
not sure that I'll be having the profits. So, what if lost? So, it's kind of discouragement, like,
Right.
right?
Yeah, I think that's a very good question in the sense that if you're going to say that all your profits are my profits and all your
Mm.
losses are your losses, then, it's
Right.
a very tricky situation. And as you very rightly said, that some investors may be discouraged from this kind of a investing, and they may look at it as a already it's a very volatile asset, and now on top of it you have taxation, which is a flat 30% with no loss set off. Probably the intention is to warn investors that look, this is what you're looking at. But there's also another way to look at it, that finally the Indian government has realized that now cryptocurrencies are so big that there are so many investors that actually they said that people have been filing tax returns and including crypto income in their tax returns, that now they've said that we need to do something about it. So I believe that that is a very important and essential first step that they have taken towards cryptocurrencies and their taxation. And it's definitely a positive move. And the laws will evolve and the taxation will evolve around this. But this was really important for the investor community. At least they have some certainty, at least they have some details around how this will be taxed, and that's definitely in the right direction.
Right, right, right. So regarding this crypto only, I have another question. I want to know that what are the factors that crypto enthusiasts should consider now before taking in crypto?
Right. I think, as a general rule, before we get into the taxes bit, I would just like to highlight that if you are a person who likes to invest in crypto, just be mindful of a couple of things. Firstly, try and get some understanding of what you're getting into. So, all cryptocurrencies have a certain underlying technology, underlying thought process, and that's what you should really be aware of. Don't go after tips that you may hear from your peers and friends and in social media and whatever, that this coin is going to rise and this is going to fall. So don't go by those kind of tips that you get all the time. Try to truly understand what you're buying into. That's the first thing. The second thing is, remember not to leverage yourself, which means don't take a loan, don't get into debt to invest in cryptos, because now we have seen that we already know this is a highly volatile asset. It's unregulated. There are legal complications, and now we also know that losses are not allowed to be set off. So in that sense, be very very careful when you are making these investments. Now, coming to the context of taxation, there's also one area where the government has said that TDS rules will come into place. So if you are an investor, you have to comply with TDS. Now let's try and understand what exactly is TDS. So TDS is a mechanism where the government collects taxes as you earn your income. So just imagine, if your salary, then before your salary is paid to you, tax is deducted by the employer and deposited with the government. Similarly, say if you're a freelancer, then somebody who's, say you did a coding project or a QA project for someone, they are going to make a payment to you, but they deduct certain TDS and go and deposit it with the government. Now, this is exactly what they want to happen in terms of cryptocurrencies. And they want to say that any buyer, so if you are a buyer and you are making a purchase of cryptocurrencies, then before making a payment to the seller, you have to deduct 1% TDS and deposit it with the government. Now, this does two things. Firstly, it increases revenue for the government in the sense, rather than waiting for taxpayers to for the quarter to end when they pay advance taxes, or for the year to end when they pay their full taxes, the government earns money as you earn money. So, they will get a 1% of your consideration. That's the first thing. The other thing is any kind of TDS scenarios leave a trail in the system. So you will see that a trail gets generated as to who the buyer is, who the seller is. And whenever a TDS deduction happens, for the seller's PAN, their Form 26AS gets auto populated. So you might have seen that when you are filing your tax return in your Form 26AS, there is a TDS entry for salary, TDS deducted on salary and TDS deducted on interest income, and stuff like that. So with this also attracting TDS, all sellers will start to see a TDS entry in their Form 26As. But this has a couple of complications. The first thing is, so who should deduct TDS? Now, if you're expecting buyers to make that TDS deduction, some buyers undertake hundreds of transactions in a day and probably thousands in a month, and maybe running into a couple of thousands, maybe 10, 20,000 transactions in say about 6 months. So we cannot expect individuals to carry out the TDS compliance, because that would mean that if, let's say, I am investing in cryptocurrencies, then on every transaction I'm deducting 1% TDS, and then I go and deposit the TDS with the government, which also requires a certain form filing. So I'll have to also go and report to the government that, look, I collected so much TDS on your behalf and I'm depositing it to you. This is the PAN number of the seller. So all of this compliance you cannot expect the buyer to undertake. Probably exchanges may undertake. So the law has been worded in a fashion where it's not exactly apparent who, on whom is the onus of making that TDS deduction. It says that anyone who is responsible for transfer or consideration in respect of virtual digital assets. So, it could be even exchange, because ultimately, you have a wallet with an exchange and the seller also has a wallet with the exchange. The exchange will initiate a transfer from one wallet back to the other wallet. And, the incidence of TDS could also be on the exchange. So it's kind of complicated in that sense, and we are hoping that there will be more clarity and the government will go ahead and clarify these issues. There's one more aspect around TDS, uh, which is, or even crypto income, where they say crypto income arises on the transfer of a virtual digital asset, but they are not exactly defined what a transfer means. So a transfer has been defined for capital assets like property or gold or jewelry or equity shares, mutual funds, debt mutual funds, all capital assets. And their transfer is defined, where they say either there is a sale that takes place, or you have transferred, or you have extinguished your rights, and there are like various legal confines of how to construe the word transfer. Remember, it's not sale, it's transfer. And when we look at cryptocurrencies, there are so many complex and layered transactions that take place. For example, there are airdrops. There may be people who may be receiving airdrops, which means that sometimes when a new coin is released, some sort of agencies come and say, look, I'm offering certain free cryptocurrencies, and that's all you need. Or you may be getting into peer-to-peer lending, or you may be doing a wallet-to-wallet transfer. So it's even possible to transfer your cryptocurrencies from one wallet to another. Now, whether all of this is covered under the connotation of transfer or not, and if yes, how does the TDS complexity gets taken care of, because there may not be like a proper consideration exchange, but a transfer may take place. So in again, you may be using your cryptocurrencies to buy on a certain, there are websites in the world where you can spend your cryptocurrency and buy real goods and services. So you can go to a website and say, okay, I want to buy this pair of headphones, or I want to buy this computer using my cryptocurrencies. And those kind of transactions have they will also likely attract TDS. But exactly how we should determine when cryptocurrencies is directly exchanged exchanged for a good or a service, then how to determine, what is the value of the consideration, and how tedious compliance should take place. Or if I'm spending my Indian wallet cryptocurrencies on a foreign platform, then how does all of this come into picture? How am I supposed to deduct tds for a seller which may be located outside India? I mean, how all of this will happen? I think a lot more clarity needs to emerge on this front, a lot more. There's several gray areas which need to be cleared by the government, and we are hoping, we are very hopeful that in due course, they will either issue a clarification or they're going to make certain amendments to this law. And before, right, remember, right now this is a bill, it has not been passed in the parliament. It will be adopted by the parliament, and that's when it will become a law. So there's definitely scope there, and I feel that certain amendments may come through.
Right, right. This was a great explanation on this crypto thing, and yeah, we are expecting that government will soon release more clarifications on this crypto thing. So, another question which I have for you is, can you also please explain about the changes in the tax rules for the differently abled people?
Right. Right. So, the finance minister announced that certain help has been extended to those who support differently abled family members. So, let's take a step back and understand. There is a certain section in the Act called Section 80 DDB, under which if there is a person who is supporting a family member, a dependent who is differently abled, then there are certain tax benefits available to you. Now, the tax benefits are not based on any actual expenditure, which means it's not structured in a way that, okay, I've spent 50,000 to care for this person, so I should be allowed a deduction of 50,000. They're not structured like that. What it says is that you will be allowed a flat deduction of 75,000 if the disability is up to 40%, and you'll be allowed a flat deduction of 1,25,000 if the disability is up to 80%. So that's how it is structured. Now, one of the conditions is that if you have bought an insurance policy for which you are paying a premium to support a differently abled family member, then you become eligible for this deduction. Now, the within the the construct of this section, it said that if you have a differently abled family member for whom you are paying insurance premium, you are eligible to claim deduction. And the differently able dependent will be able to get an annuity or get a lump sum payment from this insurance policy in case the parent or the guardian, whoever is taking care of or whoever is maintaining this differently able person, passes away. So in case of death of the parent or the guardian, the dependent differently abled person was eligible to get an annuity or get a lump sum payout from this insurance. Now, the particular change which has been brought about now says that if you are paying insurance premiums towards, for this dependent differently abled person, then at the time the parent or the guardian turns 60 years old is when the dependent will become eligible to get an annuity or a lump sum payout from the insurance policy. So this is a very positive move. Just to again simplify it, that earlier the differently abled person would only get claim from the insurance when the parent or guardian would pass on. But now the differently abled person will be able to get a payout, probably an annuity or lump sum, whatever are the terms of the insurance, when the parent or guardian turns 60 years old. So this is a beneficial provision. It's if it's I think it's in the right direction, and it's a great change that they have made.
Yeah, right. So for the differently able people, they have introduced this new insurance thing.
Yes.
And for normal individuals, ATD section is already there for the medical premium. So this
Right.
is a good move for the differently able people, right? Got it. Then one more thing I have to ask is, so like there were expectations from the taxpayers around COVID compensation. So
Right.
what was it meant in this budget? You think so?
Right. So that's that's very valid that last 2 years, most of us have been impacted by COVID in some or the other way. We have seen around us, family members, friends have been impacted. And people have come forward to help out their friends or colleagues or family members, and offer them money or compensation. Even employers have come forward to help out their friends and family. So what the government has done is, and this is a retrospective amendment, so it will be in place from 1st April 2020. And what it says is that if you have received any money, any person has received any money towards expenses for COVID treatment, or received money as compensation on death, so any expenses reimbursed, or reimbursed would be in the connotation of employer, but any expenses that somebody has helped you out with, or any payment that you have received as compensation for the death of a family member, then that money up to rupees 10 lakhs, which is received within 12 months, shall be fully exempt from tax. And this has been made effective from 1st April 2020. But I would just like to point out that surprisingly, they've kept the period as only 12 months. I think this should have been beneficial, they should have extended. And there are certain employers who've sort of actually decided to assist their dependents of employees who have passed on, by supporting them with expenses, say until the age of retirement of the employee who passed on. So there are several arrangements like that which have been put into place, and I think the government should actually completely relax this requirement that such expenses or such compensation should have been received within 12 months. I think they need to relax it, and I'm really hoping that that change will come through. But right now, let's just understand it that effective 1st April 2020, if anybody has received money towards expenses for COVID treatment, or as compensation for death of family member, then that amount will be exempt up to rupees 10 lakhs. And hopefully the within 12 months condition will be removed. That's the first aspect. The other aspect is that in several scenarios, employers have come forward to reimburse hospital expenditure. So if there is your employer who has reimbursed COVID expenses, hospital expenses for treatment in a hospital, then and if that hospital is maintained by the employer, then within the definition of salary, such a benefit gets taxed as perquisite. So I'll just explain this a little more. Say if you are using a company car which has been given at your disposal, you can use it whenever you feel like, then that also gets taxed as a perquisite. But and similarly, if any employee receives treatment in a hospital maintained by the employer, or employers have tie-ups where they without getting into insurance, they are able to support or fund your visits to the hospital. So if in this scenario the employer has funded hospital expenditure related to COVID treatment, and the hospital is maintained by the employer, then such expenses will not be considered as a perquisite. And a very simple way to understand this is that if your employer has helped you out with hospital expenditure where they themselves maintain the hospital, then you don't have any tax obligations, so you'll not have to pay any tax on that. Again, this is a beneficial provision, it's a clarification, because a lot of people had this doubt. And I remember when we were talking about compensation or helping out friends and family, I myself had received so many queries where people were asking me that we are crowdsourcing to help out this person, and we've accumulated lakhs or crores to help out a particular person. Will this become taxable in their hands? So I think now this clarifies to a great extent as to how any support that you may have received or compensation you may have received will be exempt from tax up to rupees 10 lakhs.
Okay. So, say for example, if any person got infected in 2021 year, then from that date till 12 months, he can claim up to 10 lakh as exemption amount if he's receiving from anybody.
That's right.
Right. Okay. Okay. Preeti, I also saw that some amount of surcharge rate has also been reduced. So, can you give a light on that too?
Sure. So, there was a disparity in the rate of surcharge for long term capital gains in case of unlisted shares. So, what was really happening was that if your shares are listed, then we know what the long term capital gain is. It is taxed at 10%, and it is exempt up to rupees 1 lakh. But when we talk about unlisted shares, which are not transacted on stock markets, which are privately held, when those shares are transacted, they are unlisted shares, and in that situation you have to hold for 24 months as compared to listed shares which have to be held for 12 months. So when you hold unlisted shares for more than 2 years and you sell them, then you have to pay a 20% rate of tax, and then there is applicable surcharge and all of that. Earlier, all of this working would land up with an overall tax incidence of 28%. But what the government has done is, it has not reduced that 20% rate of tax, but it has reduced the surcharge. So now when you sell unlisted equity shares which are long term, which means which you have held for more than 2 years, your effective tax will be around 24%. It's 23.9 or something like that. So effectively it has gone down from 28% to 24%. And let's see who all it would impact. It would impact founders of startups, angel investors, early employees, who have a significant amount of stake and they sell their shares. They will face a slightly lower incidence of tax, and I think this is an excellent move, given that we are seeing so much activity on this in this startup arena, that this will be a big relief to founders and angel investors. So this is a very welcome move.
Yeah, that's right. So I got many clarifications on all the budget things. I hope all the people have also got the clarifications. Uh, yeah, if you have anything to add on, you can.
Sure. Yeah, I think a lot of taxpayers were hoping that there will be some benefits which will come through and some deductions will be placed. But what we're hearing right now is that the government probably is in no mood to give you any extra deductions and exemptions, and they are focusing more and more on making the new regime attractive and ensuring that in some period of time we all move to the new tax regime, where there are lower tax rates but there are no deductions and exemptions. So I'm actually pretty excited about how that is going to turn out. What is it that they're going to bring into the new tax regime, and what is it that they will not bring in? So there are several deductions and benefits available in the old regime, such as HRA, LTA, ATC deduction, and so many of other benefits that we claim. If these are not replicated to the new regime and the old regime is done away with, then I think that's going to be a big problem. So it's going to be very exciting about how they're going to bring about these changes, and stay tuned with us. We are going to update you as soon as we have anything. Subscribe to our channel. We'll keep you up to date on all the tax related changes.
Thank you so much.